en vivo y en directo de la hermosa Baja Tustin en Alta California. Vamos a hablar de impuestos.
Hello everybody from beautiful Baja Tustin. We're going to talk about taxes. Taxes are the way that governments get revenues. The sources of taxes by the federal government are individual income taxes primarily, but also from payroll taxes, that's like Social Security taxes, and then corporate taxes. State gets its money from sales and income taxes, that's the states do, and local governments normally get it from property taxes. There are lots of ways to talk about taxation. A couple I'll mention. One is the principles of taxation. Two of these principles are the ability to pay versus benefits received. Ability to pay says those who can contribute more should contribute more to the government functions. Whereas benefits received principle of taxation says if you use the benefits of whatever the government is providing for you more, then you should pay more. So an example of a benefits received type of taxation would be gas taxes. The more you drive the highways, the more you use gasoline, the more gas taxes you pay for the upkeep. That's a benefits received principle of taxation. The ability to pay is the income tax. Higher income types pay higher amounts. Now, we have to look at the incidence of a tax. This word incidence means who actually pays the tax. If you tax fine champagne, then the people who pay the tax are going to be the people who are going to be high income groups that buy fine champagne. If you tax plain wrapped beer, the people who are going to be paying that tax are lower income types. So the tax burden falls on groups or individuals, and the incidence of a tax refers to that. We have to talk about marginal tax rates, and marginal, what is this? It's a bird. Marginal tax rates refer to the tax on the last dollar earned. So to show you marginal tax rates, I will show you the federal government tax rules that a single person with taxable income, adjusted gross income that is, AGI, up to $8,900 pays 10% of those dollars in taxes. From $8,900 to $36,250, they pay 15 pennies on each of those dollars. From 86 to 87. From 87 to 183, they pay 28%. I missed one. I missed the 25 category. And from 398 to 350, 33. And I may have gotten this wrong. This may be 400 and up. It's 39.6%. Anyway, the marginal tax rate, the tax on the last dollar earned, rises as income rises. So this illustrates the marginal tax rates changing as income changes. And this brings us to the types of taxes. Progressive tax, the percentage of income, that's the concept, increases as income increases. So clearly with this federal income tax, as income increases, the percent of people's income increases. That's a progressive tax. A regressive tax is one in which the percent of income paid decreases as income rises. An example of this would be a Social Security tax or any lump sum tax. Sales taxes also. The easiest to explain is a lump sum tax. If everybody pays $1,000 tax, and for somebody who earns $1,000, that's 100% of their income. But for Bill Gates, it's a tiny part of 1% of Bill Gates' income. So if there was a lump sum tax, $1,000 each, that would be regressive because higher income types pay, like Bill Gates, pay a smaller percent of income. Remember, it's percent of income. And finally, there are proportional taxes. That's a constant percent of income. No matter what the income is, everybody pays the same number of pennies on each of their dollars. Normally it's after some deduction. That's a proportional tax. And the examples of that are flat taxes. A lot of the former Eastern Bloc countries are adopting flat taxes. At any given time in Congress, there are lots of proposals for a flat tax. It never goes anywhere. Okay, here's an example. Person A makes an income of $48,112 and pays $5,200 taxes. Person B makes $148,112 and pays $13,950. Now it looks like this is a progressive tax because the person who makes the higher income pays the higher amount of dollars. But the higher amount of dollars is not the issue. What's the issue? Hey, wake up, put your phone down. What's the issue again? Don't make me go there. What's the issue? Percent of income. It's not the dollars, it's the percent of income. So it turns out that if you divide 5,200 by 48,112, that's 10.81%. If you divide 13,950 by 148,112, that's 9.42%. Look, higher income types pay a smaller percentage of their income than lower income types. This is a regressive tax. And finally, we're going to talk about how taxes affect incentives to work and to be productive. Oh, this is the California's tax rate. That's beautiful, Alta, California. The California tax rate, 0 to 48,000, 9.3, and then after $1 million, it's 13.3 pennies on each dollar. So it's mildly progressive. Taxes and incentives. There's this guy named Arthur B. Laffer who sort of wrote this down, and it came to be known as the Laffer curve. And in a general sense, it's useful to understand the fact that taxes affect incentives. Specifying it and understanding the consequences of it very carefully is more difficult. But basically, the Laffer curve says there are two tax rates that will produce zero tax revenues for the government. The first is a zero tax rate, and the second is a 100% tax rate. If the government is going to take 100 cents on every dollar, people won't work in ways that are visible to the government. So, as we start out, if the tax rate is zero, government revenues are zero. As the tax rate goes up 1%, 2%, 3%, etc., revenues to the government increase, 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 increase. This relationship between tax rates and tax revenue is positive. But at some point, and I apologize to all the mathematicians, I didn't do this. It was drawn this way originally. I'm sure that serious mathematicians are breaking out in hives at this very moment. I apologize. But at some point, as the tax rate goes up, 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 it decreases the incentives to work, and people don't work in ways that are visible to the government that they have to pay these higher taxes on. So what this says is that there are two tax rates that will produce the same amount of revenues. R1 could be done at this tax rate, say 25%, and you'll collect the same amount of revenue if your tax rate is 80%. There are tax rates of 80%. So if you're collecting R1 and you're charging 25% tax rate, if you want to increase tax revenues, then you should raise your rates. But if your taxes are beyond this maximum point, if you want to increase revenues here, you must decrease revenues. And the essential point to this, of course, is that taxes cause changes in people's behavior. And there are lots of instances in which governments have increased taxes and collected less revenues. The problem with this, of course, is to specify what, in fact, the Laffer curve is. And for me, see this? I'll show you Mother Teresa's Laffer curve. Mother Teresa, look at that. They just raise the rates, and then at 100%, that's it. Me, this is my Laffer curve. Green for this, I'll do this green. This is my Laffer curve. Bumpity, 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 bump. I pay. But as soon as it gets to about this percent, whatever it is, it starts killing my incentives. I stop working. And everybody has their own Laffer curve, I suppose, or that is their own incentive response to taxes. All right, that's taxes. Hasta la vista.